The dollar has already collapsed. Not is going to collapse, has. Since 1913, it has lost 97% of its purchasing power. The house your grandfather bought for $12,000 in 1955 costs $450,000 today. The dollar didn't survive. You're holding the crime scene. And here's the part the finance YouTube crowd keeps skipping over. The three assets I'm about to show you aren't just inflation hedges. One of them actually weaponizes inflation in your favor, meaning the more the dollar gets diluted, the richer you get from that specific position. That's not a theory. That's a math problem. And we are going to do the math today. I've had over 10 years of running my own businesses, sitting across tables from accountants and tax attorneys who showed me how money actually moves, not how CNBC says it moves. And the gap between those two things is where your net worth either grows or quietly disappears while you're busy feeling responsible. Today, I'm going to show you the three assets you need to own before the dollar continues its very long, very boring, very real collapse. And one of them is going to make you uncomfortable. Not because it's risky, because you already know you should own it and you haven't done it yet. By the way, I built a free early retirement calculator because most online ones are mathematically wrong. They use average inflation assumptions that haven't been accurate since 2008. Mine uses BlackRock and Vanguard logic to expose the weak points in your plan. And I only ask for your email to send the report so I don't store any of your financial data. Link in the description. Now here is the metaphor I want you to hold on to for the entire length of this video, because it's going to explain everything, every asset, every reversal, every piece of math I throw at you. Imagine you own shares in a company. You bought them, you hold them, you feel good about it. But the CEO of this company, without a shareholder vote, without a press release, without a single phone call to you, has the legal authority to print new shares and distribute them to whoever he chooses. Every new share he prints dilutes yours. Your piece of the pie gets smaller, not because the pie got smaller, but because there are more pieces. Your slice didn't move. The pie just grew more slices. This is not a metaphor for a fraudulent startup. This is literally, mechanically, how the dollar works. The Federal Reserve and the US Treasury can expand the money supply, and they do, and they have, and they will. Between 2008 and 2022, M2 money supply in the United States went from roughly $8 trillion to over $21 trillion. In 14 years, they created more new dollars than existed in the entire prior history of the American Republic. Your salary didn't grow by 163%. Your savings account didn't grow by 163%, but the number of shares outstanding did. That's the dilution. And the dilution is not a future event. I'm going to call this the share printer problem throughout this video. Every time I come back to it, I want you to remember, when the CEO prints more shares, your existing shares lose value. It doesn't matter if the number on the screen stays the same. The real claim on goods and services that number represents has already shrunk. Before I get into the first asset, let me tell you what's coming in about 5 minutes. Because there's a specific type of real estate position that doesn't just protect you from inflation. It turns inflation into a business partner that works for you while you sleep. I'll show you exactly how the math works. But first, let's talk about the asset that everybody thinks they understand, and almost nobody actually holds correctly. Gold. I know, you're already tired. Gold feels like something your anxious uncle keeps in a fireproof safe next to 3 years of dehydrated meals and a map to a cabin nobody can find. And look, if that's your association with gold, I completely understand it. The gold community has done tremendous damage to gold's reputation by tying it to apocalypse fantasies instead of institutional reality. The word prepper and the word gold got fused together somewhere in the early 2000s, and it's been a reputational disaster for a genuinely important asset class. Here is the thing though. In 2022 and 2023, central banks around the world bought more gold than in any single year since 1967. That's from the World Gold Council, not from a newsletter your uncle forwards. Over 1,000 tons per year, 2 years in a row, the People's Bank of China, the National Bank of Poland, the Reserve Bank of India, the Central Bank of Turkey, these are not preppers. These are the institutions that manage sovereign wealth for hundreds of millions of people. They have entire floors of PhD economists whose sole job is to figure out where to store value over multi-decade time horizons. And in back-to-back years, they chose gold at levels not seen in 6 decades. Not tech stocks, not US treasuries, gold. You think gold is for paranoid people, but actually, gold is for institutions that no longer trust the share printer to behave itself. That's the reversal. That's the thing that matters. Why does that distinction matter so much? Because when you understand who is actually buying gold and why, the entire asset makes sense in a different way. Gold doesn't go up. Almost nobody says this correctly. Gold doesn't go up. The dollar goes down. Gold is just measuring it. When an ounce of gold went from $350 in 2001 to over $2,600 by late 2025, that wasn't gold becoming dramatically more useful or more physically scarce. That was the dollar losing purchasing power against a fixed reference point. Gold is the ruler. The dollar is the thing being measured, and the ruler is not getting longer. Let me tell you about Charles de Gaulle, not the airport, the French president. In 1965, de Gaulle understood that the Bretton Woods system, where global currencies were pegged to the dollar and the dollar was supposedly backed by gold, was a structurally unfair arrangement that allowed the United States to run deficits that other nations couldn't. France was accumulating dollars, and America was printing more of them than it had gold to back. De Gaulle, with remarkable directness, sent French ships to New York to collect gold from the Federal Reserve Vault, physical gold, loaded onto French Navy vessels, brought back to Paris. He stood in front of cameras and said, essentially, that the dollar's special status was a privilege without accountability, and France wanted real money. 6 years later, in 1971, Nixon ended the Bretton Woods system entirely. The dollar was no longer redeemable for gold at any price. The last constraint on the share printer was removed, and the money supply has never been limited by anything other than political will since that day. Now here's what most gold buyers get wrong, and it matters. They buy gold like it's a stock. They watch the daily price. They stress when it dips. They check the chart every morning like they're going to discover something. That's not what gold is for. Gold is not a return-generating asset. It is a purchasing power preservation asset. The distinction is enormous, and most people miss it completely. You are not buying gold to get rich. You are buying gold to not get poor while the CEO keeps printing shares. The goal is to arrive at the other end of this inflationary period with the same real purchasing power you started with. In a world where that is genuinely difficult to do, that's worth more than people admit. 5 to 15% of investable assets in gold is a reasonable allocation for most people, not 0, which is currently the number for most American investors under 55. Not 50%, which is what the prepper uncle recommends and which will cost you the compounding returns that equity provides. ETFs like GLD or IAU are fine for most people. Physical gold for those who want 0 counterparty risk and don't mind storing it somewhere that isn't obvious. The point is not the vehicle. The point is the position. And for most people watching this, the position is currently 0. That's the problem the data is describing. There's a man I want you to think about. Let's call him Dave. Dave is 47 years old. He works in logistics management, makes solid money, and he has $400,000 sitting in a high-yield savings account because, and I'm quoting him directly, the market feels risky right now. Dave has felt this way since 2023. Dave's savings account is currently earning about 4.5% annually, which sounds responsible, except the real cost of living for American households in Dave's income bracket, not the official consumer price index, but the experienced inflation tracked by private economists and the Cleveland Federal Reserve has been running closer to 6 to 8% for the past several years. Dave thinks he's being conservative and careful. Dave is actually losing somewhere between 1.5% and 3.5% of his real purchasing power every single year while he waits for clarity. Over the past 3 years, Dave has quietly surrendered somewhere between $20,000 and $40,000 in real purchasing power. Not in a crash, not in a scam, in a high-yield savings account. The safest place he could find. This is the share printer at work, and Dave is calling it discipline. We're going to come back to Dave. He becomes important later. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. I make one video a week, I do all my own research, and I don't take sponsor money from financial products, which means the algorithm is literally the only distribution mechanism I have. Now we get to real estate. And I need you to stay with me here, because this is the one that changes the math the most. And it works in a way that almost nobody explains correctly. The standard explanation is boring, and therefore the insight gets lost. Let me try something different. Most people think about real estate as an appreciation play. Buy a house, value goes up, sell it, profit, that's fine. It also describes how most people lose money in real estate because they buy near the peak of a cycle. The property sits flat for 8 years and they decide real estate doesn't work anymore. Appreciation is not the weapon. The debt is the weapon. Here's the thing almost nobody puts together. When you take out a 30-year fixed rate mortgage, you are locking in a liability denominated in today's dollars. But you are going to repay that liability with future dollars. And if the share printer is running, if inflation is real, persistent, and above the rate at which your fixed interest compounds, those future dollars are worth less than today's dollars in real terms. You borrowed expensive dollars. You are paying back cheap ones. Inflation is retiring your debt for you incrementally every single month. This is not a loophole. This is just arithmetic applied to how fixed rate obligations work in an inflationary environment. Let me make this concrete with actual numbers. Say you buy a rental property in 2025 for $400,000. You put $80,000 down. You borrow $320,000 at a fixed rate. Over the next 20 years, assume average inflation of 3.5% per year. Not dramatic, not hyperinflation, just persistently above the Fed's target, which is approximately where we've been running. In real purchasing power terms, $320,000 of debt today shrinks to the equivalent of about $165,000 of real burden 20 years from now. You still owe $320,000. Nominally, the statement will say $320,000, but the real cost of that debt, measured in what those dollars can actually buy, has been cut nearly in half by inflation. Meanwhile, the physical property, a hard, productive asset, has tracked nominal inflation, meaning it's gone from $400,000 to roughly $800,000 in nominal terms, which in real terms is approximately the same. Your asset preserved its value. Your debt melted. The net equity in real terms has expanded dramatically, and you didn't have to do anything except not refinance into a variable rate and not sell at the wrong time. But wait, and this is the part I really want you to get. You're also collecting rent, and rents are not fixed obligations. Rents adjust with the market, with inflation, with demand. Your mortgage payment is frozen at the number you negotiated in 2025. Your tenant's rent is not frozen. Every year, market rents move, and in an inflationary environment, they move up. So your fixed expense is shrinking in real terms while your income stream is growing in nominal terms. You are simultaneously short the dollar on the liability side and long a hard asset on the income side. The share printer is working for you, for once, instead of against everything you own. There's a story that illustrates this so clearly, it almost feels unfair to use it. In the early 70s, a couple in Phoenix bought a rental duplex for $60,000 with a 30-year fixed mortgage at 7%. For the first several years, they thought it was a mediocre investment, it barely cash flowed, rates were high, inflation was uncomfortable. Then 1980 happened, and the consumer price index hit 13.5% annualized. Their fixed mortgage payment didn't change, not by a single dollar. But their rents, which reset annually with the market, rose sharply. Their fixed cost was now a smaller and smaller share of the income the property generated. The debt that once felt heavy now felt almost weightless, nominally the same, but meaningfully cheaper in real terms. By the mid-80s, they were cash flowing on a property whose debt had been substantially eroded by inflation and whose value had risen in nominal terms to reflect that same inflation. They didn't time anything perfectly. They didn't have a sophisticated strategy. They had a fixed rate obligation against a hard asset in an inflationary environment, and they held it. The share printer, which their neighbors were cursing over dinner, was building their retirement. Now, I know someone right now is thinking, real estate prices are high, rates are high, this doesn't apply to me right now. And I hear that. The entry point matters. Cash flow from day one is not negotiable if the rental income doesn't cover the mortgage, property taxes, insurance, and a 10% vacancy reserve. You do not have an inflation hedge. You have an expensive hobby with a lot of paperwork. The debt weapon only works if someone else is paying the debt service. That's the rule. Cash flow positive from day one, fixed rate, hold through inflation. That's the whole strategy. And if physical real estate genuinely isn't accessible right now, the down payment, the credit requirements, the management overhead publicly traded REITs get you most of the inflation hedge mechanics without the complexity. Prologis, Realty Income, Equity Residential, HealthPeak. These are companies that own hundreds or thousands of properties, carry long-term fixed-rate debt on their balance sheets intentionally, and are legally required to distribute 90% of their taxable income as dividends, boring as a government form, more durable than almost anything else in your portfolio during a sustained inflationary period. Let me check in on Dave real quick. Remember Dave with the $400,000 in savings? I told Dave about REITs. Dave said, and this is real, I'd buy a rental property, but I don't want to deal with tenants. Fair enough, Dave. So I explained the REIT structure. Dave nodded. Then he said, but what if the company goes bankrupt? I said, Dave, the company owns warehouses in 47 states. The warehouses don't disappear if the company restructures. He thought about that for a while. Dave is not fast, but Dave is the person most financial content ignores, and Dave is also the person most likely to actually implement something if it's explained without condescension. So we're going to keep checking in on Dave because Dave represents about 40 million Americans who have the capital to make these moves and have not made them yet. Now, in a few minutes, I'm going to show you the third asset, and I want to warn you that it's the one people are most likely to dismiss based on association rather than analysis. There's a version of this asset that is genuinely ridiculous, and a version of it that is one of the most important financial innovations of the last 50 years, and they look identical from the outside. That distinction is what separates the people who made money on it from the people who lost money on it. But before that, I need to give you one more number from the real estate side, because this number is what makes the whole structure click into place. Over 30 years, a 1% annual fee on $200,000 in a managed account costs you $170,000 in loss compounding. That's not a rounding error. That's a second down payment on a rental property. That's the entire gold allocation we discussed. Every percentage point of real return you surrender to fees, to inflation, to dead savings accounts. It's not just that money gone, it's the compounding on that money gone forever. The share printer isn't just diluting you annually. It's diluting you at exponential scale over time. Because every dollar you lose to inflation today was also a dollar that would have compounded for the next 20 years. That's the loss that doesn't show up on your statement. That's the loss that happens in the invisible column. This is where it gets really interesting. Because Bitcoin, and yes, here we go, Bitcoin, when you strip away everything else, is a direct answer to exactly that invisible column. Let me be clear about what I'm not arguing. I'm not arguing a price target. I'm not arguing a halving cycle. I'm not arguing that Bitcoin is going to $1 million or any number that requires a specific sequence of events to materialize. I don't know the price of Bitcoin in 3 years. Nobody does. Anyone who tells you they do is either lying or selling something. I am not doing either of those things today. Here is what I am arguing, and it's narrow and specific. Bitcoin is the only asset in human history with a verifiable, mathematically enforced supply cap that is immune to political decision-making. 21 million coins total. Not a promise, not a policy, not a mandate that can be reversed by a new administration. Code enforced by a decentralized network of computers distributed across the entire planet, requiring the computational consensus of more processing power than any single government controls in order to change. The share printer cannot reach it. That is the entire argument. Let me put that in context with every other asset we've discussed. The Federal Reserve can print more dollars they have repeatedly, and the legal architecture requires almost no friction for them to do so again. The supply of gold is constrained by geology and economics, but as the gold price rises, mining becomes more profitable, more exploration happens, more gold comes out of the ground. It's a loose cap, not a hard one. Gold supply has increased by approximately 1.5% to 2% per year historically. Real estate is bounded by land availability in specific markets, but globally, land isn't scarce. Access, zoning, and capital are scarce. None of these things have a hard, auditable, unchangeable supply ceiling. Bitcoin has exactly 21 million coins. As of early 2026, approximately 19.8 million have been mined. The remaining ones will be issued on a predetermined schedule that halves every 4 years, with the last coin mined sometime around the year 2140. There are roughly 330 million Americans. If every American wanted one full Bitcoin, that would require more than 15 times the total supply that will ever exist. The scarcity isn't a marketing claim, it's arithmetic. Now, here's the thing about volatility, because I know that's the objection forming in your head right now. Bitcoin dropped over 70% from its peak in late 2021 to its trough in late 2022. I know, I watched it happen. That is a genuinely brutal decline. And anyone who had their retirement savings in Bitcoin during that period made an allocation mistake, not an asset mistake. The asset is only as good as your ability to hold it through that kind of decline without making an emotional exit. And that requires sizing it correctly. 5 to 10% of investable assets in Bitcoin held in cold storage or a regulated custodian, not an exchange, because exchanges fail. And the FTX collapse in November 2022 was a $3 billion lesson delivered in 48 hours, is a position you can hold through a 70% drawdown without destroying your financial life. 100% in Bitcoin is a position that destroys people. The difference between those two outcomes is not the asset, it's the allocation. It's always the allocation. Let me tell you about the island parable. There's an old economics thought experiment that someone actually ran with simulated data, and the results were remarkable. There's an island economy where the chief has the authority to declare on any morning he wakes up that the shell currency supply has doubled. Every time he does it, prices rise, fish, houses, tools, everything denominated in shells goes up nominally. The people with shell savings get poorer in real terms without spending anything. Then a trader arrives from across the water. He brings a different kind of shell, one found only at a specific reef that takes weeks to reach, impossible to manufacture, impossible to duplicate, with a provably finite number in existence. At first, the islanders thought this was strange. Why would you want a shell with a fixed supply? That's the question, actually. That's the whole question. Why would you want an asset that cannot be inflated? And the answer arrives the next time the chief wakes up in a generous mood. The trader's shells, unable to be multiplied, hold their purchasing power. Everything else floats away. The islanders, who had traded some of their regular shells for the trader's shells, didn't get rich. They just didn't get poor. In a world where the chief has a printing press, not getting poor is worth something. It's worth 5 to 10% of your portfolio, at minimum. Dave, by the way, when I explained this to him, said, and this is genuinely one of the wisest financial things I've ever heard, said accidentally, I don't really believe in Bitcoin, but I put $5,000 into it anyway. I figured losing $5,000 on something I don't understand is better than losing $20,000 on something I thought I did understand. Dave, without knowing it, had described position sizing more accurately than most financial textbooks. You size speculative positions by your psychological ability to hold through loss, not by your conviction in the outcome. Dave is going to be fine. Now let me give you the case study that ties all three assets together, because abstract arguments are just that abstract. Let me make this feel real. Two people, both 35 years old, both starting with $250,000 in investable assets, both disciplined, both not doing anything crazy. Person A does what their financial advisor recommends, a 60-40 portfolio. 60% in a broad market index fund, 40% in investment grade bonds. This is the standard moderate risk recommendation that has been handed to American savers since the 1990s. It was designed for an environment where inflation averaged 2% and bonds actually generated real returns. We have not been in that environment for most of the last 15 years. Person B reads the boring documents. Person B does something different. They take $100,000 and use it as a down payment on a $400,000 rental property with a 30-year fixed-rate mortgage. They put $60,000 into gold, split between GLD and physical. They put the remaining $90,000 into a diversified equity position with a 10% Bitcoin allocation, which is $9,000. Not a bet, a position. Now run both scenarios forward 20 years to 2045. Assume 3.5% average annual inflation, not a crisis, not Venezuela, just the persistent above target inflation we've been living through. Person A's bond portfolio in this environment delivers real returns that are at best flat, at worst modestly negative. That's what bonds do when inflation exceeds the coupon rate. Their equity portion grows at maybe 7% nominal, which at 3.5% real inflation translates to roughly 3.5% real annual return. Compound that on $150,000 for 20 years, and you get about $295,000 in real 2025 purchasing power. The bonds in real terms might have preserved their nominal value while losing ground to inflation. Total real outcome for person A, somewhere around $450,000 to $500,000 in real purchasing power. Person B's rental property. The debt has inflated away as described. The $300,000 fixed mortgage is now worth roughly $150,000 in real purchasing power. The property itself, tracking nominal inflation, has gone from $400,000 to approximately $800,000 nominal, roughly $400,000. In real 2025 terms, net real equity on the property alone, $250,000, generated on an initial $100,000 investment with the tenant having paid the mortgage. The gold allocation of $60,000, having preserved purchasing power rather than generated real return, is still worth $60,000 in real terms. The equity portfolio on $75,000 at 3.5% real annual return, approximately $150,000 in real terms. The $9,000 Bitcoin position, and here I'll use a conservative scenario, where Bitcoin merely tracks its historical deceleration and doesn't repeat its early explosive returns, could reasonably be anywhere between $30,000 and $90,000 in real terms. Even at the conservative end, person B's total real outcome is somewhere between $540,000 and $600,000 in real purchasing power, comfortably ahead of person A. With dramatically lower correlation between assets, meaning no single collapse in any one category destroys the whole thing. The point is not that person B is a genius. The point is that person A owned only assets denominated in the thing being diluted, and person B spread across assets that have different relationships with the share printer. One comedic note here. Someone is inevitably going to comment, but what about tax implications? Yes, there are tax implications for all of this. Gold held for more than a year is taxed at the collectible rate 28% maximum, higher than standard long-term capital gains. Real estate has depreciation deductions that make your CPA genuinely excited. Bitcoin is classified as property by the IRS, meaning every sale is a reportable event. If you are doing any of this without a tax strategy, you're leaving real money on the table. My point today is asset selection, not tax optimization. Get the structure right first, then get the tax attorney, because in that order, you'll actually follow through. Reversing the order means analysis paralysis until the market has moved past you. Here's something I find genuinely funny about the whole situation, in an amused, not angry way. The people most likely to be watching a video called 3 Assets You Must Own Before the Dollar Collapses are the same people most likely to already own 2 of them. And the people who most need this information, the ones sitting entirely in checking accounts, savings accounts, and a 401k they haven't reviewed since the Biden administration, those people would never click this video. They think this is for paranoid people. They think this is a fringe concern. Meanwhile, the central banks of China, India, Poland, and Turkey, which are not known for their fringe financial views, have been buying gold at the highest pace in 60 years. The World Bank publishes the data. It's not hidden. The institutions already made their move. They just didn't send you a notification. Let me bring Dave back one final time. The last time I talked to Dave, he had moved $30,000 of his $400,000 savings account into a REIT index fund. Not a lot, enough to matter. He bought 4 ounces of gold, a purchase he described as embarrassing but correct. And he had put $5,000 into Bitcoin in a regulated custodial account, not because he converted to anything, but because he finally understood that his discomfort with the asset was not a reason to have zero exposure to the only supply-capped liquid asset in existence. Dave is not moving fast. Dave is not exciting. But Dave is now sitting in a position where 3 different asset classes are responding to inflation in 3 different ways. 1, preserving purchasing power. 1, using fixed rate debt as an inflation weapon. And 1, holding a position that the share printer fundamentally cannot dilute. Dave's $400,000 is no longer entirely dependent on the goodwill of one CEO with a printing press. That's a better position than Dave was in a year ago. Not perfect, better. And in personal finance, better is almost always the enemy of waiting for perfect. So let me give you 3 specific, non-generic takeaways that apply exactly to this topic and not to some generic wealth-building listicle. First, check your gold allocation today, not next week, today. Log into your brokerage. Add up what you hold in gold, GLD, IAU, physical mining stocks, and see if it's between 5 and 15% of your investable assets. If it's 0, you're holding all your measuring tape in the currency that's being shrunk. Fix it incrementally if you can't fix it all at once. 5% is infinitely more than 0. Second, if you own real estate with a fixed rate mortgage, recognize that you are holding an inflation weapon and do not refinance it away carelessly. If you don't own income producing real estate and can't access it directly, open a brokerage account and look at the 3 largest publicly traded REITs by market cap. Not as a hot tip, as a structural position in a hard asset category with built-in fixed rate debt mechanics working in your favor. Third, decide right now with a specific dollar figure what 5% of your investable assets looks like. Not Bitcoin specifically, 5% of your investable assets. What is that number? Write it down. Then ask yourself, what is the one asset I currently own 0 of, and why? If the answer is, I don't understand it, that is a solvable problem. If the answer is, I don't trust it, ask yourself whether you trust the alternative, a currency whose supply has grown by 163% in 14 years more. Because you are already exposed to that bet. You just didn't choose it consciously. 3 assets, 3 structural positions. Not a portfolio, a posture. A posture that says, I understand what the dollar is, I understand what dilution means, and I am not going to let the share printer silently reduce everything I've built while I wait for a better time to act. Lazy investing built more fortune than crypto memes. And if you need any more proof, the central banks already moved. They just didn't send a press release about it.